In this blog, we're going to cover the top 10 tax increases that may happen in the UK budget on 26 November. We'll cover the possible tax rises specific to property, but of course, other taxes also affect property investors and landlords, and so we'll cover all the likely rises. At the end, we'll discuss how any such tax rises may affect the overall returns for property investors and landlords. Now, I have to say, I have no inside knowledge of what the Chancellor is going to do to fill the estimated financial gap of 20 to 40 billion in the budget. But this is a good summary of what commentators and other experts think that may happen. Hi, everyone. I'm Dr. Tariq, or Dr. T, and I've been in the property business for almost 50 years. Here's a bit about me. In the 1980s, whilst working as a junior doctor, my hobby was computers, and I co-founded one of the UK's largest PC manufacturers with over 3,000 staff and brands such as Tiny, Opus, and Time Computers. Computer manufacturing moved to China by early 2000s, and during the past 17 years, I've researched and analysed the UK property market and developed a property business for 100% passive investors that is different to traditional agents and property companies. My children and over 100 staff now run this business, but I still help out with strategy, marketing, and client advice. We've appeared on the BBC's main property show over 7 times, bought, renovated, rented out, and resold almost 3,000 low-cost houses, and we continue to look after these for our investor clients. I'm now retired from my part-time NHS work, but I really enjoy helping people with property investment and making videos like this. Before we dive in, if you find today's information useful, please hit the like button. Drop a comment below letting me know what you'd like us to cover next. And make sure you subscribe and hit the bell so you don't miss future property tips. It really helps the channel and spreads the word. Let's get back to the video now. Let's first discuss property taxes. There's 4 main types that have been talked about. I personally think that some of these that affect landlords are not likely, as any such increases will just result in higher rents for tenants, and the government will want to avoid that. But here's what's been discussed. Stamp duty reform. There could be changes to stamp duty, the idea being that stamp duty could be scrapped on new personal home purchases and replaced with an annual tax on the property. This wouldn't affect investment-type properties. The annual tax could be limited to more expensive properties, for example, those over £500,000. Mansion tax. Separate to stamp duty reform, there could be a standalone mansion tax, which would, for example, be an annual property tax on properties over a certain value, for example, over 2 million or even a million. This would affect London and the South East more, and overall, this could gradually increase the demand for lower cost houses in these areas. Capital gains tax on own homes. Now, at present, you don't pay capital gains tax on any profit you make when you sell the property you live in. But they could change this on the sale of more expensive properties, for example, over £500,000. So that capital tax then is payable on the gain you make. This will also affect London and the South East more, where you find the most expensive properties. And this could also stop people from selling and moving to smaller homes. And I think this tax change is not likely. National insurance tax on rent. It's been mentioned that the government could add an 8% national insurance tax on rental income. Out of these 4 property taxes, this is the only property tax that would affect landlords and investors directly. But I have to say that this tax is unlikely, as it would just result in immediate rise in rents, which goes against the government's aim of easing housing costs. Number 2, income tax. Let's talk about the main tax, which is income tax. There is speculation that income tax may rise by 1 to 2%. For example, the basic rate could go from 20 to 22%, and the higher rate increase from 40 to 42%. If this happens, the government may not need to tinker too much with the smaller tax increases or the property taxes, but this will break the government's manifesto promise not to raise income tax. And frankly, if they do this, voters may not trust them on any future promises. Still, if the budget deficit is as big as expected, they may feel that they have no choice. And there is also likely to be freezing of personal allowances for longer. For example, the 20% tax threshold could remain at 12,570 and the 40% tax threshold at 50,270 per year. And then as wages and incomes rise, more people will fall into these brackets and hence pay more tax. National insurance. Some have suggested that employee national insurance could be reduced by 2%, whilst at the same time increasing the income tax by 2%. Theoretically, this would protect working people that pay national insurance, as they will not be affected overall. But this will also reduce the benefit of the tax rise to the Treasury. So I'm not sure if this will go ahead, but it is being strongly mentioned in the media. If you haven't subscribed yet, now's a good time. We publish content every week on UK property investing. Hit the bell and like. It really helps the channel and ensures you're notified when the next video is released. VAT. The rate of VAT may remain at 20%, but the number of businesses charging VAT may increase. At present, a business doesn't need to charge VAT if their turnover is less than £90,000 per year. Now, this could be lowered to £50,000 or even £30,000. If that happens, then almost every significant business will end up charging VAT. There could also be additional services that are currently VAT exempt, but may have to charge VAT in the future, such as private health and tutoring type services, and even charities. Inheritance tax. Now, the inheritance tax allowance is £325,000 per person and up to £500,000 if they own their own home. For a couple, that's a maximum of £1 million. So if you pass away and have assets above this level, you pay 40% inheritance tax on the excess. Now, you can gift any amount to anyone, and there is no tax if you survive 7 years after making the gift. Now, many people use gifts to reduce their inheritance tax liability. For example, gifting their properties to their children after they retire. The inheritance tax rate and the allowance are not likely to change, but there could be changes to gifting, either on the limit you can gift or the period you have to survive after giving the gift. For example, this could be increased to 10 years. Pensions. Now, with pensions, the big negative change has already happened, as pensions are now within your assets for inheritance tax. There could be 2 further changes that could happen. At present, higher rate taxpayers get 40% or 45% tax relief on the funds they put into their pension pot, whilst lower rate taxpayers get only 20% relief. The government may change this to a flat 25% or 30% for all. They may also limit the tax-free lump sum which you get at the age of 55. At present, it is 25% of the pot, or £268,275, whichever is higher. You've got the option to take that at age 55. Now, the maximum amount could be reduced, for example, to £100,000. Now, when pensions were included within the inheritance tax scope last year, many people decided they would take the cash-free lump sum and put it into property, for example. This is because property gives them more control and usable income now and can be gifted to children to reduce their inheritance tax liability. Reduction of the lump sum could affect this strategy. Capital gains tax rate. Now, currently, capital gains tax is at 18% to 24%, which is much lower than income tax. the government could bring capital gains tax closer to income tax levels, perhaps gradually over several budgets. This would be a significant change for property investors and business owners alike. Now, I'm going to briefly mention three other possible tax rises. ISAs, the annual tax-free cash ISA limit may be reduced from 20,000 to 10,000, thereby encouraging people to invest into shares rather than cash savings. There could be windfall taxes on banks. They earn interest on money they deposit with the Bank of England. This may be taxed to encourage them to lend more. And the so-called sin taxes, they may be increased, for example, on alcohol, tobacco, and gambling. And there could even be increases on fuel duty. So what do you think is likely in the budget, and how will it affect property investors? Please make any comments below. In my view, the government's thinking has shifted over recent months. At first, they seem determined not to touch the big three: income tax, VAT, or national insurance, and instead raise funds through smaller, targeted measures like property or inheritance-related taxes. But now the gap seems to be so large that the simplest route may be to break the manifesto promise and raise income tax directly. It's politically risky, but maybe unavoidable, and maybe the best solution. For property investors, though, I wouldn't worry too much. Even if property taxes do rise, rental demand remains strong, and rents will simply adjust to cover costs. The fundamentals of supply and demand are still firmly in investors' favor. This is because demand for rental continues to increase because house buying remains unaffordable for many. And renting is becoming more desirable due to the government's changes to increasing renters' rights and have better property standards. And on the other hand, rental supply is not increasing. In fact, it's becoming tighter. So any cost increases for landlords will just pass through onto tenants, and overall investment returns will not be affected. Please watch the short message from our sponsor at the end. Thanks for watching.
Have a look at this amazing two-house offer. Buy a large 3-bed house for under £97,000. Instead of getting rent for the next 5 years, you get another house for almost half the price. Thus you can get 2 flexi-furnished houses, together worth around £176,000 for just £137,000. And your final net rent is over £12,300 per year with no costs, making your net yield 9% of your payment. You pay only around £100,000 now and get full ownership of the first house, and you reserve and fix the price of the second house now. So you get capital growth on this too. But you pay for it at time of transfer, which can be up to 5 years later. This package is ideal for investors who don't need rental income right now, but want to reinvest that rent in the most efficient way possible to get more property, higher rents, and greater capital growth for the future. Visit findukproperty.com and fill out an inquiry form. The website explains property solutions for all budgets from £70,000 to £127,000. All these houses are fully renovated, already rented out, and contractually guaranteed. You buy them and then rent them back to Find UK Property for 7% net rent. They cover all the costs and liabilities so that you can be a 100% passive investor living anywhere in the UK or abroad. Most investors buy in one step from the main house range and start getting 7% net rent now. If your budget is lower, use the 2-step process to get one low-cost property over 3 years. And if you have a higher budget, you can consider the 3-house investment offer. You get 3 houses, but effectively pay for just 2. The third is paid by the future rent of all 3 houses, interest-free. Your eventual net rent is almost 10% of your investment. Demand for UK housing remains higher than supply, and property prices in the north are growing at a rate of around 5% per year. Our prices are rising by around £2,000 on each property next month. If you can make the reservation now, you secure these current prices and can thus save £2,000 on each house. These offers end 28th November. Visit findukproperty.com and speak to a consultant today.